Hi, good morning, everyone. Welcome to 1X Insights. Today is October the 4th. We've just had the non-farm payroll report coming out for September. And right now, the market has opened for about 10 minutes. So what we're going to do today is going to go through the non-farm payrolls data and then discuss and provide a live market update on all the key assets across TLT, SPY, QQQ, the Magnificent Seven stocks, Bitcoin, Ether, gold, silver, as well as the BDCs and the exchanges and the China equities that we covered in this service so far. So there's a lot of ground to cover today. So let's dive in. Non-farm payrolls came out very strong today. So new jobs added, 254,000 versus 147,000 forecast. So it smashed the forecast by over 100,000 new jobs. I think this figure will likely get revised down like the previous ones, where it came out so strongly. But still, it's a very good report. And also notably, unemployment rate dropped by 0.1% to 4.1%. So now I think the recessionary fears that we had back in August is really receding fast. Also, another notable data point is the average hourly earnings up 4% year on year, or 0.4% month on month. So again, this is stronger than forecast. And potentially this could be having any inflationary effect on core inflation or non-housing services. So let's just go into the actual more details on the trends. As we can see, we had a weak period of non-farm payrolls in June, July, August. But even back in August, I said that we're still adding new jobs, right? So people tend to forget that non-farm payrolls can be negative, which would be very recessionary because it's intrinsically linked to the GDP. But we are still in an expansionary era where new jobs are being added every single month. So the economy overall is still very strong, even as unemployment is creeping up slowly from the very tight labor market unemployment rate of 3.7% a year ago. I think, and I think the Fed would really welcome this trend of unemployment rate going down, having peaked from at 4.3%. Now moving down slowly each month, and I think it strengthens the Fed's argument that the labor market is just normalizing at the moment, and they don't see substantial risk of deterioration or recession. And of course, the sum rule was triggered around here, and if we look at 2001 and 2007 data points. The recession all started with unemployment rate in the low 4% area, and then it moved up quite fast. So still, I think we should still be very wary of this risk that this downtrend could just be actually transitory, and we could get worse unemployment data next month. But actually, with a natural disaster this month, we might actually have, I think the next month figure won't look that pretty anyway, but then you could argue that's going to be a one-off event, et cetera, et cetera. So, so I think there's still a lot of data to be seen before we can conclude we're in the recession, but we just have to stay on our toes. Before the data, before today, I shared this chart with the Slack community, which is basically saying that the change in unemployment rate, which is what the Fed cares about, and the change in initial claims move with each other quite closely. I mean, they're odd month out where initial claims moved up, but unemployment rate moved down. But broadly speaking, they tend to move in line with each other most of the time. So going into today's non-farm payroll, initial claims for August actually dipped again, second month in a row. You see, so it's below zero, below this line. So that actually is supportive of unemployment either staying in line or coming below expectation, which is a good thing for the economy. So today's unemployment change was not really a big surprise because we have these changes in initial claims data already. And overall, the labor market doesn't look like it's deteriorating fast yet. And again, unemployment, so hourly earnings up 4%. And if you look at the trend, underlying trend, so the year-on-year trend started moving up in July, but actually on an annualized basis, which means the monthly changes so using the 3 monthly changes and extrapolate that on an annualized basis, we see that the trend has been moving up since as early as April. And this trend here is supportive of higher non-housing services inflation or core inflation. So I think inflation is not something the Fed cares too much about right now because of the labor market situation. But at some point, if non-housing service inflation rebounds higher or trends higher, it might come back to our attention again. And then we may, and if labor market softens further and we get high inflation, that could get into a stagflation scenario, which is kind of like the worst of both worlds. So this is a risk factor we have to keep in mind. But on the positive side, you could argue that businesses are paying high wages for labor. Indicates that labor market demand is still quite strong, right? So it's two sides of the same coin. So what are we pricing in now for FOMC? So the chance of 50 basis point cuts in the next meetings have basically gone below 50% now. The primary expectation is we get 4 consecutive 25 basis point cuts, much less aggressive than what we priced in before. And actually for May or June, we are likely just get 1 cut in between. It could be in May, it could be in June. And then we will skip another meeting and then we'll have 1 more cut. And the market actually sees the terminal yield to be higher than before. So before we had terminal yield at 2.75%. Now it's 50 basis point higher to 3.25%. So that is substantially higher, actually, I think, than what the market previously expected. And it's probably what the Fed would argue for at the moment, suggesting that neutral rate is higher. How is there opportunity here? I think there's a little bit more room for the market to move higher in terms of yields in the near term, but beyond that, I actually still think the market, the yields should go lower than what's priced in the medium to long term. To visualize this decision point, a lot of cuts up front, pretty much done by September, and then 3.25 terminal yield. Again, this is the SOFR, so for 3-month futures. This future is more liquid. It stretches out to a longer horizon, so it's much easier to visualize what the market prices in beyond just next year. Okay, so moving on to Fed liquidity. So the Fed liquidity, for those who haven't seen this chart before, if you're new to the service, is essentially the Fed balance sheet minus the Treasury General Account balance with the Fed, minus the reverse repo program volume, plus the bank term funding program, which is the rescue funding for the the regional banks that were going bankrupt last year. So if this total liquidity figure is going up, it means the Fed liquidity is expanding, therefore is supportive of risk assets. If it's going down, then it means the Fed liquidity is shrinking and is not supportive for the risk assets. And we saw this broad relationship pretty much going up until this summer. But more recently, we've had Fed liquidity shrinking quite rapidly from just above 6.25 trillion, now down to at some point below 5.9 trillion, and now just also still below 6 trillion. So this is a quite big swing within basically a month from mid-September. And a lot of it's driven by the higher repo activities in the RRP. So it's a bit surprising that the stock market is still so big given the shrinking liquidity. So it suggests that we might have the carry trades back on, or that the Chinese liquidity injection has some spillover effect into the US. It's not terribly clear what's driving this at the moment, to be honest. Because this liquidity chart does have an impact on the 10-year Treasury yield, because lower liquidity means there's less demand for Treasury bonds, and therefore Treasury prices fall and Treasury yields go higher. And you can see that's been this case where liquidity goes down and 10-year bond yields go higher. So I think it remains to be seen on why on the carry play, whether the carry trades are back or there's a liquidity spillover from China. But on the spillover effect, I would actually expect more risk-on play from things like big crypto, which we haven't really seen yet. So I think that is a piece of puzzle we just have to keep an eye on for now. Okay, now moving on to the live market analysis. So I'm going to switch to TradingView and we can go through all the stock market tickers. All right, so now looking at SPY. I've changed my chart count a little bit because I did initially have 1, 2, 3, 4, 5 up, and I thought this was an A and potentially a bigger B. But actually, just zooming out a little bit, I think we've already completed A here, and we had a B correction here, and that leaves room for the next wave up, the C wave up to wave 3 here, and that would be proportionate in terms of the length of A versus C. So C is just about 1.236 extension of A, which is my expectation. But even though, even though we should be moving higher in the beyond into the year end and into the early next year, I'm still expecting some sort of correction here, wave 2 correction. It might not be as steep as I initially projected, but I do think we should get something like a 61% retrace from this entire wave 1, or maybe as shallow as 50%. But right now, if we're counting this as a wave 2 complete, is simply too shallow for my liking. I mean, it could happen, but because the overall market is quite bullish, but it is still quite. I'm just wary that we could still get this little downturn here in the near term, possibly going into the election, and that would coincide with if there was a lag in the stock market versus the Fed liquidity balance as well. And then moving on to QQQ, I think the QQQ has done a bit more correction so far on this wave 1 and 2. I think this is quite a shallow pullback. It's just around 38% for this entire wave 1, but that is much better. That's a much better count than SPY. I think we should get one more leg lower from here to get to something like 0.5 to 0.618 retrace before we head higher. And actually, on the back of those very bullish non-farm payrolls, we didn't really, try to break out into a new high. We opened higher, but now the market does look a bit tired already. So I do think still, like in the near term, we should get a small correction here. But going to year end, my projection is still going to be higher into the year end and making new highs. TLT, I think we got this pretty spot on here. We had a wave A here, which I did try to do a trade to attempt higher from this point, but we stopped out. But since then, the market just been going down, and that's now moving towards our wave C target. I think the wave C should, at a minimum, break below 95. And could go as far as below 94, but that could be a little bit of a stretch. So anywhere between 94 and 95, I think, would be my target for wave C based on what's happened so far. And this B wave pullback is also quite shallow. So the overall market seems to be supportive of higher yield in the short term and the lower bond prices. TLH, again, similar. The market took a nosedive on the back of positive non-farm payrolls, yields higher, and I think we probably get a bounce in the near term, and then a final leg lower to 105 to 106 region. So oil prices. This is an interesting one because I think a lot of people in the inner circle channel have had a had an oil play. So just zooming out a little bit, we're still within this broader consolidation channel, as in we're actually just right in the middle of it. So to me here, let's say my overall bias is bullish as my primary expectation. And if we have built a 1-2 and a 1-2 here, I think wave 3 should be 103. So actually that indicates we're still very early in this move. We should at least try to clear this wave 1 high at 83. So might be a lot more legs to this move. It might not get there, tomorrow or next week, but that would be my projection, bullish projection, if indeed oil has still in the long term this fifth wave to complete. And of course, so high oil prices means higher inflation, and I think that's also been supportive of bond yield. So generally, if you look at the headline CPI, it basically moves in line with oil prices, as well as the forward inflation expectation. Okay, so moving on to Bitcoin. So Bitcoin, I think we did bottom here, and we've built a 1-2, and we're moving towards 3. So nothing so far has diffused my thesis, even though if you just zoom out a little bit, we're still actually in the middle of this broader channel here. So we really to be completely bullish, I think we should have to clear this wave 3 high, and there's still a lot more room if you're conservative and buying at the breakout 73 for a profit near the mid 90s. That's still a decent profit, right? So right now my primary expectation is higher, but of course, the risk reward is better, but the chance of a completely bullish move is also not as high as if already broken out of the wave 3 high. So it's a trade-off, right? Whether you want to bank high gains versus bearing high risk that this is actually just a bear rally. But just zooming into the technicals, the hourly chart. So when it was Bitcoin was falling in the past few days, I essentially highlighted this box here, a blue box here, to be the supportive zone. And I think this has, so obviously we dipped through here, which is a major area for volume support. But over here, we also had a bit of a volume here, a strong volume profile here to support a base, short-term base here. And actually, it coincides with my wave 2 projection here, because this wave 2 projection really is between 0.78 and 0.618 retrace, which is a quite natural area for wave 2. Going below this area here would be quite would get me obviously worried, and then dipping below this wave 2 low is a short-term invalidation of the bullish trend. So I do think we're now just above the support. We should have bottom here, into bottom over here, and my primary expectation for the next move is up towards 73k. And to be honest, like if I was entering a trade today, because I've already had a trade at 57k. So, but if I were to enter today and aiming for this target of 73k, it's still pretty good risk reward, right? So we have a reward of 18% or so and a risk of 6%, which gives you a three times ratio between reward and risk. So I do think that's still decent trade. The key is that with Bitcoin, you have to be the asset is very volatile. And you have to be very tight with your. You have to be very disciplined with your stop. If you just let it slip over here and say, I'll just watch it, then your trade thesis essentially has changed from short term to long term, and that should be a new trade. So if I were to play a short term trade, this is what I would put on, and I would definitely stop out if it breaches this level. But if I didn't stop out, then I'll be in a tough position on, okay, so what next? I basically have to reevaluate my account. So I really advocate for disciplined approach to trading volatile assets like this. Ether generally hasn't been as bullish as Bitcoin, because even at the wave 4 low, the bounce has been pretty weak. You can hardly, it's hardly forming a 1-2 here. And I think the market is making a distinction between Bitcoin as a long-term store of value versus Ethereum as a smart contract network-driven commodity that is more intrinsically linked with the activities of the network than the long-term store of value narrative. And just zooming out to the daily chart, I do think that it's pivotal that we essentially don't breach this level here. So from the Elliott wave perspective, we don't want wave 4 to be overlapping with wave 1. That's one of the Elliott wave rules. Probably a bit more loosely applied for commodities, but still, like when it overlaps, it kind of suggests that maybe we only have the 3 waves up rather than the 5 waves. And overall, the market doesn't have a lot of strength. But if we do stand this retrace and we stand above this support, overall direction is still bullish. I'm still seeing a wave 5 potential towards 5.7k. And if you look at this whole pattern here, just zooming out a little bit outside the Elliott wave framework, it is a cup and handle, right? As long as this handle doesn't retrace too deeply, so at the moment, if we're just looking at that, the Elliott wave, just a cup and handle. So far, this is around 30% retrace. I think that's completely fine. If it gets too deep, 50% or even 60%, that the cup and handle chart pattern also would probably fail. So key level to watch out, but still bullish primarily. Gold, I do think short term is topped. if we just look at the extensions here, so that would be a 1, 2, with 1, 2. And I think this pretty much is very textbook Fibonacci levels here, right? 1, 2, 3, 4, 5, just above the 2 extension of wave 1. So I would expect a retrace of wave 4. And that retrace would make a lot of sense as to retest this entire area that's been built up over the past 5 years. So that is the resistance now flipping into the support area. Silver, we're edging close to the wave 3, circle 3 target of 5. And essentially, silver is catching up with gold, so it could still rise. I do think it can still catch up a bit more. So the gold might top out first, and then silver finishes final 10% rally and then retrace. But I wouldn't hate it if you want to take some risk off the table, because we entered at 26, so 15% up, still pretty strong. But my expectations, we're going to get 30 and then retrace and then up to 33. All right, so moving on to Magnificent 7. We have Apple here. Apple hasn't managed to break up a new high. And obviously, all the iPhone 16 products have shipped. Mixed reviews so far. A lot of people are saying it doesn't feel any different to the iPhone 14 because Apple Intelligence is not out. And I've emphasized this a few times before. Because the Apple Intelligence is going to have a staggered rollout, it's going to take a little while for the bullish sentiment to completely sink in from here for the new Apple iPhone 16. And I really think after the first product, Apple Intelligence update shipped, we might see much more hype around Apple stock. But in any case, my primary expectation is we should get a pullback here. But the alternative is that we might have bottom here already and we're just going straight up to 300. But either way, if you're playing for medium long term, I do think we are heading towards 300 before we get a bigger retrace here. So I think I generally prefer a pullback to get into the position, but in the medium term, I'm still bullish. Amazon is one of the more cheaply valued Magnificent 7 stocks compared to its peers. And I do think we're nowhere near the top yet. I think the wave 5 high should be somewhere near the mid 200 region. Near term, we could still get a ABC pullback. So I think we've had A pullback and B wave rally today. But I think we should be able to get a C wave correction. And ideally, I want to play this trade here. So if we get C wave pullback somewhere around the 50% mark of this rally, I can enter here and aim for 237 as a target with a stop around 150. That'll give us a 3-to-1 risk reward, which is pretty nice. And I think once it takes off above this level, like 190, the volume profile here is quite thin. So we have it could rally pretty fast from here once we break above 190. Google has been much more bullish than I initially expected. So it could be that we've completed the ABC already. and we're now in the wave 3. We could have a wave 3, wave 3 rally from here. So I don't mind this trade. If we enter today as it breaks out and we put a tight stop around this wave C low, it still offers pretty good risk reward of just under 4. So, but the caveat is that if it does break through, then I do expect further downside, possibly down to 130, which is what I initially had. So it's definitely again, I would advise a disciplined approach. We're playing this setup. Not all setups can win, and we're playing probability game here. And if the setup fails, we just have to pull out and reassess. Next up for Meta. Meta should be already underway. Wave 3. We kind of missed the trade over here because the shallow pullback. But I think the next entry point could be this wave 4 pullback once it happens. That could happen at some point early next year. But overall, I think my target for wave 5 is 720. Microsoft. I'm a bit more bearish on Microsoft than other stocks because so I think we've had a 1, 2, 3, 4, 5 here, very potentially. So we are, if this is the top, we do need a pullback, a deeper pullback here. What we are at is that this wave B, and I think it's a wave B rather than a 1, 2 setup, is because it's quite proportionally 3 wave from this wave A low. And in Elliott wave framework, 3 waves up is corrective and 5 waves up is motive. So this largely points down to a downtrend in the primary direction. I think there's so if this is true and we do break below this wave A low, we can get to 350 as a next target. Nothing to do really at this point. If you want to short, I would have a stop loss at this wave B high. NVIDIA still higher, lower highs, higher lows, lower highs. So it feels. So some people would argue that this is a bull flag. I mean, it could be, but it needs to really break above all those previous lower highs to really confirm the next leg up. We've had a lot of bullish news about Blackwell chips being high in demand, etc., etc. The problem is first, the Blackwell chips have been delayed, so they are coming slower than expectation, and there's also capacity issue on how fast they can be produced. So the market did pop a couple of days on the back of the CEO comment. But still, my primary expectation, and this is different to what you might see from other people, is that we should test this support area again and possibly break below this volume support into the high 70s. But then after that, we can push high from this point. I can be completely invalidated if it clears above this wave B high of 130 and the all-time high at 140. Okay, next up, Tesla robotaxi event, and I think next week. We had a correction after the delivery miss. I think it didn't really miss by much, but I think it's just the market sentiment that we had a quite strong rally from August. It's really just trying to digest some pullback. And for me, on the smaller degree chart, I do think if we can get a pullback at towards 230 here, so if we get below here, there's not a lot of volume to support the next fall. If we can get a pullback down here, I think it's brilliant entry point. And I think you can play two ways. We can play this entire rest of wave 3 here, which is 70% up towards 400, with a wideish stop below this wave 2 low of 20%. So that is 108, somewhere around 180 point. And that will be the next support level, right? But if you just want to play a much shorter game, I would have a stop here and a target here. So still pretty good risk reward, targeting the 320 area and with a much tighter stop at just around 210. And the problem with Tesla and also Bitcoin is that they're very volatile. So the rallies can be quite big and the pullbacks can be quite big. So a tight stop can knock you out a trade that you don't want and immediately sees another bounce. So essentially you get whipsawed. Hopefully it doesn't happen if you play this, but that is the risk of playing a short-term high stop game. And finally, looking at China, I will cover more Chinese stocks in a second. I think we've just broken above this wave. We've won high here. This is very bullish. I still expect a pullback some here before we can head higher to wave 3. But breaking above this is very bullish for the stock, above in this channel. And I think the primary expectation is we're going to head towards this wave 3 high at 60. So there's still a lot of room up there. But from this point, the Chinese government already has cut the monetary policy rate, as well as forcing commercial banks to lower mortgage rates and lower the bank reserve, etc. So these are on the supply side or the credit side of things. I would really want to see the more stimulating the demand side, the consumer side of things. And that should be, so the monetary policy should be coupled with fiscal policy to really unleash the beast, as it were. So I think, I don't know if the Politburo is working on that side of things, the consumer side of things, but overall, I do think we are starting a new bullish trend. So the next part, I'm going to cover some BDCs quickly. So I haven't covered those charts before in BDC because for a while, I didn't think technical analysis is that applicable to BDCs, which is because they have a net asset value. So we're really just trying to play the premium and discount game to the net asset value. But when I zoomed out and really look at the charts, we can actually apply the Elliott wave framework quite well to those charts. So I think we should give it a go and see how it works. So I think we had a cycle wave 1 high and wave 2 low between 2013 and the COVID low. So you just zoom in a bit. We've had 1, 2 just right after COVID, 3, 4 just the COVID rally, post-COVID rally, and the bear market. And I think we're in the wave 5, in the overall wave 5, and we're in the wave 3 or 5. I think today we're just 5% above in terms of premium. So if we get to wave 5, that's probably looking more like so if I'm just calculating the premium, it would be more like 30%. And I think some of the BDCs like Main have even 70% premium. So this is well within a normal range. So if I were to trade this technically, I think I would put a quite tight stop here at this low. But overall risk reward, it's probably nothing. I will still want to rely on the dividend yield that it's producing. Overall, I'm equal weight on this sector because the Fed is lowering rates, which means the net interest income from those BDCs are also coming lower. OBDC, again, I think we had 5 waves down in COVID, and at best, I'm counting 3 waves up here, 1, 2, 3 here. So I think overall, whereas this is still a bear rally, even though it's a really big bear rally, and in the wave C, we're near the end, towards wave 5 of 18. The net asset value is 15. We're in a discount area, so to get to 18, we're looking at something like 20% premium. So this would be the trade setup, but it's not a really great risk reward here anyway. Actually, sorry, the large price is here. So I think this is much better risk reward if we have a tight stop here, wave 4 low to ride the wave 5 high, also to capture the dividends. So that would be quite a nice setup. BXSL, these are very sharp guys from Blackstone, but it looks like they are on downtrend, essentially, I think. So we had 5 waves up, and I think we're now in the ABC correction area. I mean, we could say this has already bottomed, but it's fairly shallow for wave 2, if this is a wave 2 and we're heading high overall. So I do think we have a A and B wave rally. So I'm expecting a C wave. And this is not that much discount, where it's like 10% discount to NAV. So this is well within a normal range. That discount went as low as 30% before. FSK, okay, the NAV is very high at $23, and well below this area as in terms of discount. I do think in the large time frame, we had 1, 2, 3, 4, 5. So we're in the 5th wave. And if I were to trade this, I would put a stop just at this wave 2 bracket too low and playing this wave 3 high. So again, that offers something like 3 to 1, 3.5 to 1 risk reward, moving from discount to NAV to premium to NAV. But to be honest, it's not a really easy chart to dissect because there's a lot of zigzag, a lot of consolidation essentially from 2021. So it doesn't look terribly bullish, and we are really in the early days of this wave 3. Obviously, clearing this wave 3, circle 3 high would be ultra bullish, but then you're leaving money on the table if that happens. But if you're more conservative, I would wait for this wave 3 high and then enter at this pullback. Main trades at nearly 70% premium, but actually it doesn't seem to be done yet. So I see wave 1, 2, 3, 4, and we're already breaking above this wave 3 high. And I think we're easily into this wave, moving towards this wave 5 target of 67. And I would actually put us towards something like 100%, more than 100% premium. And it does sound a bit stupid on why would someone pay 100% premium. But at the moment, I think the main's yield is like below 6%, which is just above the Fed funds rate. A couple of percent, 1.5% above the Fed funds rate. So there's clearly a lot of appetite for investors for this. And with Fed funds rates going higher, it's possible that dividend yields also want to move lower. Sorry, with Fed funds rates moving lower, it's possible that investors also see dividend yield are willing to accept lower dividend yields, which means higher prices over here. GBDC, it's not clear that we are in 5 waves up. I do see this more like an ABC rally, but I think for the purpose of short-term trades, it doesn't really matter because this C wave is still substantially higher than where we are today. And the way I would play this is for this C leg is to have a stop below this wave below, which is 7% from today, and high of a target above 20. And that again is a nice 4 or 5 to 1 risk reward. So yeah, so I've covered all of this except for OBDC in with fundamental analysis as well. So you can take a look at the articles I've written. Exchanges, I've done. So S&P Global, I think is very bullish. It tends to move up with the stock market, of course. So I see significant upside from here. In terms of trade setup, I mean, you could I can't really see a good. Possibly, if we enter today, we want to use this wave 1 high as a stop, but a stop here I'm playing with. But the risk reward is not terribly good, so I'd much rather wait for this pullback and play the wave 5 high after wave 3 and 4 completes. So that could be a while. So for me, no setup, but clearly bullish trend. ICE, again, I think is moving high generally, but we would do a pullback from this wave 3 high and then we're trying to finish this wave 5. And I think we should get a final wave 5 target of 230, and that could be a cycle wave 3, larger cycle wave 3 target as well for completion. After that, I see significant pullback, but that's still a long while to go. So yeah, so ideally enter probably here, or if you're conservative, enter probably here to play this final wave. CME, essentially I'm waiting for a wave 2 pullback, and I think that's a really attractive point. I don't know how shallow or deeper it could be because there's a lot of volume profile built up over here to support this region, but I see CME moving high towards above 300. Of course, always ideal to break above this wave a high, but yeah. So with 300 is my target, and if once we get pullback, I would just use this low, wave 2 low, as a stop. Moody's Corporation, near term, I think we should get another pullback from here. And then finish near just below 600. So nothing to do right now, to be honest. MSCI Global, it has been less bullish than other stocks, other exchange stocks, and in fact I feel it's pretty much struggling to break above this wave circle 3 high. So I do think we're due a bigger pullback, and also the reason I think there's a wave B is because this rally from wave A, again, it's not very clear that it's a 5 wave up, and I don't think it is. So it just feels the market is not really, it's a bit tired. It just can't quite get above this wave new all-time high, and it's been 3 years since. So breaking above, obviously a bit more bullish. I can probably take off this corrective waves. But so far, I still expect primary trend to be down. Nasdaq, I think we're in an up move, and I will just look a bit closer to see. So I think in the long run, I think we can get to 120. In the short run, I think we can play this. I'm quite inclined to play this, but I think we need a quite good tight stop, because the upside is only 20% from today's. So wave 3 should be already in motion here with 20% upside for this. Ideally, I don't really want to go. So this risk reward doesn't really scream too good to me. So I want to be much tighter. So I might use the top of wave 1 as a risk, as my support, but it's a bit tricky setting this, I think. So it's really up to the individual on how tight or far they would want to set, and whether they want to pursue catching the rest of this wave at all. CBOE, 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, 7 year, 8 year, 9 year, 10 year, 11 year, 12 year, 13 year, 14 year, 15 year, 16 year, 17 year, 18 year, 19 year, 20 year, 21 year, 22 year, 23 year, 24 year, 25 year, 26 year, 27 year, 28 year, 29 year, 30 year, 31 year, 32 year, 33 year, 34 year, 35 year, 36 year, 37 year, 38 year, 39 year, 40 year, 41 year, 42 year, 43 year, 44 year, 45 year, 46 year, 47 year, 48 year, 49 year, 50 year, 51 year, 52 year, 53 year, 54 year, 55 year, 56 year, 57 year, 58 year, 59 year, 60 year, 61 year, 62 ye I see a near-term pullback quite imminent, so I wouldn't go long here. I wouldn't do anything here, and I would just wait for the pullback before I play the final wave C. So yeah, nothing to do. And on the larger degree level, after this wave 5 completes, I'm expecting substantial pullback from here. FDS, I think we're in wave 5 of 3 of a larger degree cycle wave 3, and wave 5 can get to 700. On the very short term, a lot of is consolidated quite significantly from January 2022, essentially. There's a lot of volume built up here. So I think once it takes off, clears above this high, this blue zone here, it will move pretty rapidly towards 600 at least. So I want to get a good pullback just so I can use this support zone as my stop and still get a nice 3-to-1 risk reward. We do have quite significant resistance here trying to break above. It's tested a few times in the past 2 years. So I want to, essentially my trade would be wait for this pullback into here or even lower and then attempt higher again and attempt for this to break out. Coin, we have this as set up already in our channel. So it's interesting. So if you just ignore that Elliott wave theory or the counts for now, it's very clear cup and handle chart. So the long term, I expect coin to go up with Ethereum, Bitcoin and Ethereum, and especially with ETF flows and ETFs, a lot of ETFs using Coinbase as the custodian. I think overall there's a lot of room on the upside for Coinbase, and the wave 5 target could be as high as 480, which is triple the price from today. So I actually really like this on a long-term basis. Do nothing, just ride this entire wave 5 up to triple my investment. But in terms of Elliott wave, I see wave 1, 2, 3 completing in beginning of this year with Bitcoin, and then its consolidation wave 4. I see wave 4 sufficiently complete. There's room to go down further here, but I'm not too bothered if I'm playing long term, and then wave 5 up. So I think we have put in a bottom. And just looking at the shorter term trade, if you are not patient, on the hourly. So I have a stop here at 145, and my target is for the wave 1 of that larger degree wave 5, which is 230 area. And that gives us a nice 40% reward and 11% stop loss, which I think is pretty good. Right, and once it breaks above the current level, if you look at the volume profile, there's a lot of resistance over here, but it's quite a big gap over here. So it can take off pretty quickly for people to catch up. And then we can see a resistance in this region and then pull back again, and then before taking off higher. In the very near term, the reason I have to stop here is because we could have bottom here in the very short term, but there's a chance that this is actually wave 3 only, and we have wave 4 high bounce, and there's a leg lower. But that doesn't really bother me because that's why I've set a stop here. So even if I'm wrong in the short term, that we have a new lower bottom where I'm still in the trade, and it's well within my risk parameter. And finally, some Chinese equities. So Alibaba progressing through wave 3, not much to do here. I would really want to see a pullback if I can enter the trade to pay the rest. Otherwise, I'll just sit for the wave 3 to complete, wait for the wave 4 and go higher. longer term, I think we can get to a medium term. We can get to 240 area, and obviously the very longer term, much higher on a decade basis. JD very similar to Alibaba, as I covered in a recent note. I think we're progressing through wave 3. Need a pullback to complete this wave 3, complete short term wave 5 here, or just be more patient and wait for this pullback here. PDD, best growth for valuation. So I think it's the best of breed in terms of being very aggressive. You've used Temu app in US or Europe, they're expanding really fast in overseas market of China. And I think it's much more advanced in terms of its progress and stock price recovery than Baba and JD. So I think I'm very inclined to play the next pullback and play this wave 3 up. And I think that's a very decent trade in terms of risk and reward. I would put a stop just below this wave 2 low at 82. The IPS, much a smaller entity than the other ones, I think is recovering nicely from this wave 2 low. I think we can play a short-term trade, aiming for this with 5 high and with 11 as a stop. It's up to the individual whether they want to do that or they want to wait for this wave 1 to complete and wait for wave 2 pullback here. And again, I will just caution that in terms of time frame, this wave 3, it sounds really ridiculously high, 5x from here. It might not happen in the next month or so. This is not what I'm saying. I'm talking about multi-year progress. So we have to be patient. This is a longer term chart. This is a multi-year bull. We're playing up for a multi-year bull market essentially. So I would caution. I would basically say wider stop, higher target, and just be patient and allocate carefully, not to be too over allocating essentially. Li Auto, pretty much a consolidation pattern over here, a wide range since IPO. It's really tough to play this one, and I wouldn't play this one essentially. I want to see a breakout essentially before we can get any sort of reliable projection for beyond this channel. NEO, overall the chart, we have a rebound from this low, from April low, but overall this downtrend is pretty bad, pretty steep. It has put a higher low, which is great, but it nowhere, by no means clears our downtrend pattern from here, right? So I really want to see more progress, substantial progress to, I sound like Jay Powell now, but I want to see substantial progress of breakout, retest, before I can say, okay, it's now really back into the primary uptrend. And the thing is, we can afford to be patient because the sky is really high from here. If this is 1, 2, wave 3 is easily much higher on a multi-year level. So with the EVs, we'll have to be careful because if Trump wins, we'll have tariffs coming ahead. We already have tariffs from US and EU on Chinese EVs. But if Trump comes in with broader tariffs on Chinese imports, sentiment could really sour for essentially Chinese EVs. XPEV, again, I think it has bottomed, but again, it would be much nicer to break above all those new lower highs from before to really confirm the uptrend. BILI, I like BILI. It's basically like the YouTube plus Twitch of China, maybe more towards Twitch. I think wave 3 has not finished yet. We have a lot more room to go. I am watching for a setup here. Ideally, I want to see a pullback from this aggressive wave 3 rally, pullback towards 22 area where we can have a really nice play towards 40. Wide target and wide stop, 4-to-1 reward is what I'm aiming for. NetEase, positive bottom, but I think this is very hard resistance zone here. We could have put down ABC here. Actually, would likely would have. So I want to see a pullback here to play the 1-2. And also you could just be patient, wait for this to break above this blue zone, blue box here, and to play the retest towards wave 3. TME, Tencent Music. Primary trade, I think it's actually we're in the larger wave 2 correction. It's not like the other BABA and JD, where it's heavily influenced by Chinese government policies. This one has had positive sentiment since the Bill Wang scandal, essentially, where Bill Wang was pushing the stock up. Well, here he essentially got arrested, bust, and 5-wave low, 5-wave down. So the stock is rebuilding. I see 5 waves up here, which puts us into a primary uptrend. But I think there is a short-term correction to come yet. So nothing to do. Weibo, long-term correction again, long-term downtrend. I think we could have a bounce towards wave 4, but I just wouldn't play it. I think we might head lower. Weibo is the tutor of China. Edu, again, I think we should have a C wave correction here before we get wave 5 from this wave C low. So nothing to do. I'm going to wait for this correction. BIDU, which is the Google of China, should have put in a bottom here. Just looking at the larger degree, I think BIDU has a much longer history than other stocks. So we had 1-2 in financial crisis, 3-4 post-COVID, and I think we're now looking at wave 5 up. I don't mind playing this longer term and this could be a double bottom. And if we have a trace up here for wave 3, let me just see this risk reward, 200% versus around 30%, or maybe even here tighter, but I would probably put out here 35% wave 4 low, just in case this is just a bear rally. This is pretty 5-to-1, 6-to-1 risk reward. This is a pretty good long-term trade. Again, I would say the China equities, think of them as one basket among other baskets. So just this is all multi-level charts, multi-year charts. Don't go overboard on one particular stock just because this projection is high, and have very tight risk control, disciplined risk approach. Auto, don't really see that much. I think we still get wave C high, down low here. But alternative is that we might have bottomed, like Baidu. It's the reason I've got a lower low here is because how aggressive this has come down. It's not terribly clear that we have bottomed here, to be honest. But this is a support area. If I were to enter a trade, definitely have this as a stop loss here. BEKE, BEKE, I think is near the top for wave C correction. 5 waves down, 3 waves up, still larger bearish trend. BZ, which is the recruitment platform in China, possibly bottom at wave 2 here. Now looking at wave 3, but in the short term, there's not much we can do here because it doesn't have offer of pullback, doesn't really give us much chance to catch the trade. So I would just sit tight and wait for the pullback. FUTU. FUTU is a chart where it's very close to the all-time high, but all the waves up are ABC and all the waves down are 1, 2, 3, 4, 5 waves down. So it does make me feel like this is still a larger ABC wave down, bearish trend. So this uptrend is ABC here. It's not that bullish in terms of the pattern, but obviously we're closing on the all-time high. So if we do break it and then retest, maybe I can play the wave 3 or 4 here, but I don't quite see it yet. TCOM trip, a much more bullish chart than others, I think, because it's already broken all-time high recently. And we're building a 1, 2, 3, 4, 5 So this is the company that bought Skyscanner. So I do think this, and this is a carbon, this looks like a carbon handle pattern as well in the classical analysis. So I do have quite bullish expectation for this. Finally, Yum China, which owns KFC, Pizza Hut, etc., Taco Bell in China. I see a pullback first, and then wave C rally. The overall pattern has been consolidation, not a clear trend. So nothing to do for here. So that's it for today. It's quite a long webinar. I would stop here. If you have any questions, please comment on Slack or comment on the next video. So thank you and have a lovely weekend.